Have you ever found yourself in a position like this, where there are multiple zones to buy from, and you're not sure which one to use for your trades? This can be confusing and lead to a lot of losses and missed wins. So in this video, I'll be teaching you about inducement and how you can use it to prevent losses and make gains in this position. When the market is moving in a clear trending direction, in this instance, bearish in a downtrend, sometimes there's going to be more than one zone to pick for your shorts. In these instances, this is where inducement zones come up. For example, here we have the inducement zone, which is the red box. And then we have the true zone, which is this green box. Basically, an inducement zone, or inducement as a whole, is just a trap. It's an area in price that looks good for an opportunity, but often won't hold. This inducement zone here may entice or induce sellers to enter the market when that level is met. You may see this zone and look to go short here, but what happens a lot of the time is that these inducement zones are not respected, and instead of reacting from these points, the market will trade through towards the true zone, which is the green box, and then follow through with the larger movements further down. The reason that this happens is down to liquidity and imbalance. And an imbalance is an open price range, meaning a supply zone like this that hasn't been retested yet. If the price movement had pulled back and retested this supply, then this lower supply zone would be a good one to sell from. But because we have this imbalance left open here, there's space here where there is liquidity. In this area, there will be stop losses from sellers looking to take positions here, buy stops from buyers who are looking for the breakout trade, and a significant number of orders from institutional participants. We know these are institutional orders because the large movements that we see in the markets are generally driven by institutions. Retail traders are simply not large enough to drive the market in the same way. Because of the open imbalance, the liquidity that builds up in this area, and the institutional orders, the market is unlikely to respect the inducement zone. Instead, it will push up to fill the higher supply zone and the imbalance above the swing high. A push through into the top supply would fill all the orders situated here, and would also fill the orders situated in the imbalance price region, before then continuing further down. So you might be asking, can we just place a sell limit order at the inducement zone like this, and another at the top zone? The problem with this is that if the first zone fails, and the second zone also fails, you take two losses, not one. If in a downtrend, and we have 2 to 4 supply zones in play, we should not sell from every one, as you could get yourself with a 2 to 4% loss in a single day. Instead, we have to use inducement theory to filter out low probability zones and focus on prime points. So now I'm going to take you over to a real chart example to show you what inducement looks like and how to take advantage of it. Looking at this leg of price action, there are multiple zones which we can buy from, and the market is in a clear uptrend with higher highs and higher lows. So we only want to buy upon pullbacks. And there are multiple possible demand zones which we can buy from. So you can see we have this top demand zone here, as this was a period of consolidation before this impulsive move up. Then we have this mid demand zone here as well. And I'm marking these demand zones as the last candle before the impulsive move up. Then we also have this extreme demand zone at the bottom here. So we could potentially buy from any of these demand zones. Now, if you were buying from the market, would it be from the top, middle, or extreme demand zone? Well, the top demand zone is eliminated because there's a clear imbalance below it, leading price towards the mid zone. So we can eliminate this top demand zone. This leaves the mid zone and the extreme demand zone, but there's an imbalance in the extreme zone as well. So which demand zone do you think we should trade from? You may be thinking it's the lower one because we have more imbalance. But if we look closer at the structure of the market, you can see we had this push up, push down, push up, push down, and then this push up. After this push up here, we had this wick, which failed to break above the structural high, as we didn't have a close above. Then we had this rejection. The market pulled back and had to reaccumulate before pushing up higher and breaking the high of this structural high. So therefore, this extreme zone was not strong enough to break the swing structure. The true break in structure came from this mid zone, which means this is where the real buying strength originated to push the market into a new high in the trend. Although the extreme zone broke some internal structure here, like this, it didn't create the higher time frame break needed to confirm the strong demand zone. Therefore, it's less important than this mid zone, and therefore the extreme zone is not as significant a strong demand zone. When we're looking at demand and supply, we're looking to see which levels these supply and demand zones are able to break. This extreme demand zone was not able to break into a new structure high, implying it's not as significant as a demand zone, as we had this wick above the structure high, but there was no confirmed close above. The market pulled back, and then we only closed above this high during this impulsive move up, and it was the mid zone that actually built the strength needed to push the market into the new high in the trend. So therefore, we can eliminate this extreme demand zone, and the area for buying would be this mid zone. However, the extreme demand zone can be valid for a potential trade if the mid zone breaks and if we were to get the right confirmations on the lower timeframes coming out of this extreme demand zone, especially as this extreme demand zone did break some internal structure before price pushed up. However, the mid zone was a demand zone that was responsible for breaking past this major swing high, and so this mid demand zone is more important. So now we know the inducement zone is a top demand zone here, the extreme zone is weaker, and the mid zone is a true zone to buy from. We're expecting the top zone to be pushed through and broken, as this is the inducement zone, and we're not expecting the market to come all the way down to the bottom zone, as real strength to move up came from the mid zone. So in terms of trading opportunities, we would look for something like this, a push down into the mid demand zone and then a push away. If you want to play it safe, you can look for trading entry confirmations on the lower time frames. And once the market comes down to this mid demand zone, you would look for a confirmational shift. So you want lower time frames to move from lower lows and lower highs to higher highs and higher lows. And when this takes place, it validates a setup. We're currently on the 1 hour chart, but we can go down to the 10-minute to identify confirmations and reversals. So I've now moved on to the 10-minute chart, and we want to refine our entry to the last candle before this impulsive move up. So refining it like this to this red candle, as this is the last candle before this impulsive move up. And we ideally want to be buying from this demand zone here. So price came down into this demand zone, then we had a small push through, but after we had this immediate push up in momentum, on the 15-minute chart, you can see we had this major wick rejection of the lows and then a break of the lower time frame structure. So this is a potential buy entry. And so I'm going to hop down to the 10-minute to actually mark our entry. So I would mark out the demand on the 10-minute chart. So the last candle before the impulse was here. And this is where we would look to buy from, especially as now we've had this confirmational shift forming a higher high, taking out the highs here. The entry would be at the top of this demand zone, stop loss below the lows, and the target would be the previous highs as we're looking to take the trend upwards now that we've identified the best zone to buy from. So to recap the zone selection, we had a top demand zone, which was the inducement zone, as there was a clear imbalance below the area. We also had an extreme zone, but that was weak in this case, as it was not responsible for causing a structural shift. And so the true zone was a demand zone that originated here, as it was the area that created the structural break, and it had the highest probability of holding. So now that we're left with this high probability position, let's jump into the higher time frame and let the market play out. As you can see, price is pushed up, driving up into new highs, continuing the trend and producing a profitable trade. Now that you know how to identify and trade inducement, make sure you're always looking out for strong zones that caused major structural breaks, and also consider imbalances because liquidity in these areas are likely to be driven through. And instead of taking losses, now you can trade with the knowledge to wait for inducement zones to be swept before entering at the true zone. And now that you've learned about inducement, you still need to learn about supply and demand. So check out my previous video to learn more about that.